Good morning, everyone. A very warm welcome to our audience and panel members. I am Kevin Higgins with Oxford Street Retail Advisors in Boston, the moderator for today's panel on the future of retail. We have a wonderful panel assembled today. Please allow me to introduce our four panelists. We have Brandon Famous from CBRE in Philadelphia, Andrew Vaughn, CEO of Redevco, Andrew McMurdo, Head of Debt and Advisory at Savills in London, and Stephanie Price, Partner at Baker McKenzie Law Firm in London. Each panelist will introduce themselves with a brief bio and describe what they are currently seeing in their retail sector and what they expect post-COVID. You're welcome to ask questions either to the panel in general or direct to a particular individual, and we'll do our best to answer as many questions as possible. Most questions we'll try to get to with 15 minutes to go in during the session, but if we see a question that we can weave in properly during this discussion, we will. So with that said, and Brandon, why don't you start us off with a short bio and what you're currently seeing in the retail world in your sector.
Sure, thanks. Thank you, Kevin, and thank everyone for joining the call. We hope today you will come away with a few thoughts, maybe learn a few things while we're at it, and we have an enjoyable dialogue back and forth. By way of background, I have been in retail for over 40 years. A large portion of those years, I owned a retail brokerage company focused primarily on retailer representation, and that company on the eastern seaboard of the United States. In 2013, I sold the company to CBRE. There's a lot of reasons why I sold that. We can discuss that at any other time. And the last 7 years I have spent leading CBRE's global retailer representation practice. In January of this past year, I transitioned over to brokerage, where I'm focusing on helping retailers expand not only nationally, but globally. So I want to talk a little bit about what I'm currently seeing in the retailer business. And mind you, it's not going to speak to every single retailer. These are very, high level observations and brief because we only have a few minutes for this. And we'll talk a little bit about post-COVID. The first thing I want to tell you is that, contrary to popular belief, availability in prime real estate is somewhat and has been somewhat limited. A locations remain A locations. There are exceptions: New York, Los Angeles, Paris. There are opportunities, even London to some extent. There are opportunities, although I expect those cities to rebound quite quickly. Also, the absorption in B or C locations is increasing as well, primarily in suburban markets versus the urban centers. Now, I was asked, well, who are you seeing expanding during COVID? Who's fared well? So briefly, the grocery sector, the home improvement sector, health and wellness, off-price budget apparel have fared very well, along with fast food and fast casual, particularly those that have drive-through. The other thing I want to mention is that COVID has forced many retailers to rethink their e-commerce offering. You know, the COVID caught many unprepared, and going forward, they're going to need to reevaluate their supply chain logistics strategy. Lastly, in terms of actual, what's happening with retailers in terms of financially, yeah, many struggling retailers still continue to battle through abatements and deferrals, while others that are expanding are adopting COVID or pandemic language going forward within their leases. And I can explain a little bit about that in a bit. Post-COVID, what do I see post-COVID? I see a surge similar to 2008, 2009, really a surge of brick and mortar activity. Retailers, there's going to be retailers who couldn't afford certain markets now have that opportunity to go into markets that they otherwise couldn't have afforded. Obviously, there's a pent-up demand. You're going to see many different sectors expanding. And again, look for fitness and furniture actually to grow significantly post-COVID. That's not limited to that. And the other thing too that you'll find is what COVID has done, and you'll see it more post-COVID, is the heavy use of data and analytics. it has forced retailers to really rethink their entire retail offering. And I will close with this, Kevin. Mind you that I have to say this, required to say this, that what I'm telling you or suggesting to you today are my opinions and my observations, not necessarily those of CBRE. So with Kevin, I'll turn that back to you.
Brandon, thanks. Great introduction. And
thank you.
Next we have Andrew Vaughn with Redevco. Andrew.
Thanks, Kevin. So I can't quite match Brandon's 40 years in retail. I've done about 20 years out of my 30-year career. So maybe I'm just a newcomer. So I've been with Redevco 20 years. I've been in the current role since 2011. I'm CEO. I always have to say when I've done 20 years with one company, I've had about 3 or 4 different jobs in that period, but at least 10 years with the current job. Redevco, we're a privately owned investment management platform focused on European retail. So a lot of my comments will talk about Europe, but we've got other people that can talk about the US and other parts of the world. We manage a portfolio of around 7.5 billion euros across about 10 countries, and that's around 300 assets. We're mainly what we would call in Europe high street or downtown for those in the US. So I always sort of feel, particularly in some of these discussions, when often I'm with the biggest shopping center owners, I often describe us as a bit the champion of the high street. So maybe there's some reflection of that in some of my comments. So what do we see? Maybe to start with a very obvious statement, that the sector is going through enormous disruption. And I think it's creative destruction, actually, is what's happening. And the reason I call it creative destruction is because you hear a lot about the destruction, but there's an awful lot of creativity as well going on. And both in terms of technology and new formats, and we'll talk about that, I'm sure, but also I think it's creative destruction because to some extent, I think it's been necessary, because for the last 20, 30, 40 years as an industry, I think we have to take some responsibility for building too much retail. And that was fueled on the back of developers building, often funded by the banks and supported by retailers with global supply chains, and an era of kind of mass production leading to mass consumption. And we built it and the retailers filled it. So before we even start talking about things like digital and COVID, I think we had an oversupply issue in the sector. Some countries are worse than others, and US, followed by UK, tends to be higher square meters per capita than other parts of the world. So I think before we start talking about some of the new trends, we already had a bit of an issue on oversupply. So as we look forward, how do we see the retail landscape? I think for us, and again, my comments reflect a little bit our business model very much focused on cities and towns. I think you really have to look at the future of cities to understand the future of retail. And those cities, particularly the best cities and the most livable cities, the growth of those cities will be driven by population growth, by demographic changes, and by urbanization, which has been going for some time. It's not just about Asia, it also happens in Europe. So the best cities, the most livable cities will continue to grow. That supports, if you like, the future of retail. And then beyond that, the sort of mega trends that I think are really influencing, as Brandon said, the rise of e-commerce. I think there's 1 or 2 concepts where it works in pure play e-commerce, but for the mass market, I think it's just an accepted fact now that it really is the synergy between online and stores that works the best. I don't think anybody really sort of questions that anymore. It's really the synergy between being online and being store-based. So that will continue. Consumer trends will continue. I think there's a whole new generation coming through with way more interest and concern about the environment. So the rise of circularity, the rise of resale, the rise of supporting local products and locally produced goods, particularly in food and beverage, is a big trend that I think will impact the sector, as well as I think the whole issue around data analytics and the fact that retailers are using increased data to be able to identify the locations they want to be in and where their customers are going, both before they go to a store and maybe after they've been to a store. So there's a lot around innovation and technology that I'm sure we can come on to in the Q&A. So the summary is absolutely retail is not dead. I think depending on which stats you use, something like 85% of global goods still touch the store at some point or another. Retail is absolutely not dead, but it is going through a major transition. And I think the way that certainly we look at our portfolio, we tend to look at it, we ask ourselves two questions. The first is, does your asset have locational value? And that can be either driven by footfall, very high footfall location, like a Champs-Élysées or an Oxford Street or Fifth Avenue. So it can be a kind of footfall driven measurement, or it can be about convenience, that it happens to have a convenience. So does your asset have locational value? First question. Second question, if the answer is yes, it does, the more difficult question is, what is the appropriate rent for that piece of asset or that piece of property? So Kevin, maybe I will leave it there for some initial thoughts and then look forward to the discussion shortly.
Andrew, that was terrific. Thank you. For the audience's purposes, there are two Andrews. So we'll have Andrew V, who just spoke with Berdevco, and now Andrew McMurdo, who will be Andrew M, who is head of debt and advisory at Savills. Andrew, please introduce yourself and tell us what you're seeing.
Thanks, Kevin. Yes. Hello, everyone. Andrew McMurdo. So I run Savills debt advisory business across the UK and Europe. I'm feeling that my experience is nowhere near the depth when it comes to retail specifically, but I do have 30 years experience in the debt market. So prior to joining Savills, I used to be at HSBC. I ran their global syndicated loan business. So many years dealing with all the different lenders across the landscape. I think, if we think about it from just my market standpoint for a second and go, is retail dead? Will people lend to retail? And the answer is yes, they will, and they are. In fact, we've done 2 deals this year in the retail space, but they're very, very particular about which parts of that they're going to currently lend to. So the deals we've done have been in the retail warehousing space, where many of the tenants actually have been essential retailers. So they've been able to operate throughout the COVID period. And those are the sorts of assets that people have been prepared to lend against. Many of the lenders have a view on alternative use for those types of assets. The other thing that is really changing a lot in Europe, probably led by the UK, is the actual lender class. Brandon will be very familiar with this in the US, that it's really changing in our markets now as more and more non-banks enter the market. So these are, a combination of, some of an insurance company, some are specific debt funds, but increasingly what I would refer to as global asset managers, who are strapping on a real estate lending strategy alongside other debt strategies they've had, but also equity strategies. And that's bringing new capital and a different risk appetite, which is really important, because many of the banks have legacy exposures, which frankly at the moment are causing their credit committees more concerned. And so it's very difficult for them to lend any new money. So as we see the market unlock, I think you'll find increasingly, certainly the deals we've done this year, none of them have been led by banks. They've all been non-banks. That's probably enough for now, Kevin, until we get into the debate.
Yeah, that's terrific, especially the pivot to non-bank lenders, which hasn't been very traditional in the UK in the past. So we'll touch upon that more as we go along. Stephanie, please introduce yourself and let us know.
Thanks, Kevin. Morning, everybody. So I'm a partner at the law firm Baker McKenzie. I studied land economy at Cambridge, actually, and that sort of started my love of property, I guess. And I think my love of retail just comes from the fact that I enjoy shopping and luxury brands. I did go to the Oxford Institute of Legal Practice for my final year of law exams. And then I've been at Baker McKenzie ever since. I trained there. I spent some time in our Hong Kong office, and I've qualified into the real estate department and been there ever since. I specialise in the retail sector. I sit on the firm's consumer goods and retail industry group, My clients are predominantly international luxury retailers, but I also do act for some landlords and lenders in respect of their retail portfolios. We've been pretty busy since the start of COVID, advising obviously on the changing laws and advising landlords and tenants on their strategy, navigating through the various lockdowns. We've seen an awful lot of rental concessions, so I suppose that's when the lawyers are called in to document that. So we've seen break clauses being exercised, negotiations of rent reductions, rent-free periods, rent deferrals, and then switches to turnover rent for those tenants that have been successful in their negotiations with landlords, but then also for the tenants less successful in negotiations, we've seen claims against those tenants and advising them on that. Also acted for landlords dealing with tenant CVAs or insolvencies and administrations, and also, of course, lenders dealing with their borrowers' tenant CVAs, such as quite a lot of instances with Debenhams. In terms of the future, I think for the UK, the crunch point is likely to be the 30th of June when the moratorium on forfeiture ends. I don't know that we will see that much of an immediate change, as perhaps a non-paying tenant is maybe better than no tenant at all. And of course, totally depends on the location, as some of the other panelists have already mentioned. And based on that location, I think what we'll see is a lot of repurposing of retail stores and perhaps a reimagined high street. So from a personal view as a consumer, it's actually quite exciting time. I think we will see a bit of a shake-up of the industry and probably very much survival of the fittest, the death of some and the evolution of others. And from a practitioner point of view, I think with this, we'll just see a greater need for flexibility in leases, retailers needing and wanting to be more nimble and flexible to cater for the changing demand. So I think that's the future.
Thanks, Stephanie. We are seeing that in the US where anchor tenants who have traditionally had 15-year terms with options have been veering for 10-year terms, and smaller chains are actually going for 5-year lease terms versus 10, looking for that flexibility. So I think one of the touch points here is, so we have the overbuilding, we have retailers expanding, and we have rent concessions. So as you know, rents really climbed high in a lot of these markets to the point where retailers, it was almost impossible to make money on some of the high streets or flagships, either whether it's Oxford Street in London or Fifth Avenue in New York. So coming out of post-COVID, let's start with Brandon. Brandon, what do you think your retailers are seeing from a rent discount standpoint? And if they can capitalize on it now, do they think we're going to get back to a point where rents on Fifth Avenue exceed where they were before COVID? And then Andrew, with Redevco, asking you as an owner how you deal with these rent concessions and how it affects your portfolio. And then Andrew M., how you deal with that from a lender perspective, or when you're financing something as it's coming out of the end of the loan. And then Stephanie, how you negotiate these things. So that's a lot, but that's what I'd like to cover first. So
sure. I'll start, Kevin. Yeah, I'll jump in, Kevin. So you look at, I think, New York, Paris, Dubai, by way of example. New York, you have today many retailers looking at New York. Remember that the mentality of retailers right now, those not struggling to survive, but those that are actually doing well, are looking to the future saying, we're going to come out of this in the very near future. And because of the gestation period of a deal, they're starting to look now. We've been very, very active with retailers looking at their fourth quarter 21 strategy and their 22 strategy, which means they're out there negotiating right now. But what that means is they're really focused on, for example, New York, where you have rents that are substantially lower, some cases as much as 50% lower than pre-COVID. Post-COVID, do I think they'll get back to those numbers? I think that's going to take quite some time. Dubai, same situation, where you have rents significantly lower. Paris, where there's key money isn't an issue anymore for the most part. So certainly retailers that are being very opportunistic. Now, the question, and I'm going to throw this back to Stephanie for a second, is what we're seeing is, we spent a lot of time the last year working on abatements and deferrals, turnover rent type deals. But those retailers that plan to open Q1 22, Q2 22 are now putting in language that says this simply, I'll call it pandemic language, which says, okay, we're going to pay 100% rent unless by whatever mandate there is, we can only have 50% occupancy. Accordingly, our rent will be 50%, will really be based on what the occupancy level of our premises to be. So Stephanie, are you seeing any of that currently in terms of retailers going forward?
Yeah, absolutely. We're seeing quite a mix of that. Some actually don't seem bothered at all. When we go to them and say, do you want a pandemic clause? They're like, no, it's fine. We'll leave it as it is. But then, which is pretty surprising, but others, absolutely. And then of course, it comes down to, yeah, how you define that. And it's not just this one. I think now, obviously, people are concerned about future pandemics. Will the next one be next year? Will it be in 100 years' time? So it's really dealing with the triggers, how long that lasts, if it's just the closure or if it's a period after the closure, and it's sort of how that's dealt with. So yeah, I think the industry as a whole is definitely kind of considering all of these pandemic clauses and the different connotations and variations of them.
Thank you. So Kevin, one last comment is that you sort of have this fine line between taking advantage of current or favorable market conditions for retailers that are looking to expand, and those same retailers saying, well, we have cash reserve that we need to be cautious of in the event there is a third wave and there is a continued lockdown, if you will. So it's a balance that you have to play. It appears that it's shifting towards the more positive in that there probably won't be a third wave, but no one really knows. So how do you as a retailer address that from a financial standpoint? You need to open stores. You need to supplement you need to drive sales, and you're going to do that through brick and mortar stores. But at the same time, how do you survive if yet there's another year-long lockdown, so to speak? So Kevin, back to you.
Sure. And a lot of it has been done with, sort of on the back of the landlords and there have been some recent cases, and we can get to those in a minute, Stephanie. So both Andrews. So Andrew M., when your investors or non-bank lenders are looking at these loans going forward, and maybe it's a little hard to clarify, how do you think they bake in the risk of, before, if you had a lease with a major national chain, you called it a bond lease. You knew you were going to get your rent for 10 years, no matter what. They were going to pay their rent if their business was great or not great. How are lenders sort of handicapping that with either LTV or more equity from, the owner of the building? What are you seeing on that, or think you'll see?
Yeah, I don't think we've seen that actually manifest itself yet in any new deals. But inevitably, it's just going to drag down leverage ultimately, because it's going to be a question of people looking at the risk profile of the transaction and considering that it's changed if the underlying cash flows coming through have got that element of uncertainty in it. We have seen on one deal that we're doing recently, there was some language put in there to effectively give some protection to the owners if, I guess, it was aimed at a third wave. And the lender was okay to do that, to give a period of recognition that we're in a very, very uncertain period, certain times. And, they were structuring the deal in today's market, getting priced off today's market, and therefore they were prepared to do that. So I think widespread, we've not seen it yet, Kevin. But I think if it becomes a major part of the market, it's just going to affect people's appetite for risk, and therefore I would think lower leverage.
Thank you. Good answer. Thank you. Andrew Vaughn, what are you seeing from the owner's side on the rent side coming out of this? And how are you dealing with rents that are dropping on assets you've had a while? And I'll let you take it from there.
So I'd say the first thing is we have certainly given a number of pandemic clauses, let's say, in new leases. Not all of them by any stretch. I have to be careful in case there's any retailers are listening to this, so I get quoted on it. But we have given some in some cases. Look, we just generally, we took a decision very early on as a company that, so sort of over a year ago, the beginning of the lockdown one, that we felt clearly a clear responsibility to share the burden with the retailers. So again, I can't say that all of our deals were the same. And in fact, we took a decision not to do a kind of company policy, right? We're going to, split it or whatever. We're going to negotiate individually with all of our tenants. And it was an enormous challenge. I mean, I think over 1,000 negotiations across the portfolio. But we ended up losing effectively 2 months of rent last year, which, on the basis of out of 12 months you can potentially capture, we only lost, was that 17% of the rent. So we were supported by food and quite a lot of out of town, where DIY in many parts of Europe was able to keep open. So we did pretty okay, to be honest, we felt, on a relative basis. I think, this is just, again, it's all about COVID, but real estate has become more and more operational. You just, as an asset owner, the days of, an office building or a shop where you let it for 15, 20, 25 years, collect the rent and forget about it is long gone. So I think this is just another sign of real estate becoming much, much more operational, and asset owners and managers having to accept way more operational responsibility. So we have seen some examples. I was a little bit shocked. A few weeks ago, I went to London, my London office, for the first time. I live in the UK, but I'm based out of Amsterdam. But I go to our London office quite often. And I came out of the tube station by Bond Street, for anybody that knows it. And I was quite shocked at how many shops were boarded up for various reasons. Some of it COVID related, some of it not. But I think, as Brandon said earlier, I don't worry about London or the big cities will be fine. They'll bounce back, because someone was telling me last week that they went to the office and it was absolutely heaving with people. So the big cities will bounce back. We did have a vacancy, COVID-related vacancy, on a store on Boulevard Haussmann, so Paris, top kind of high footfall location, and we had an offer on the table, which was what we would call a soft offer in a depressed situation, and we decided, look, we can either just hold on and just wait for a year or two for things to really recover, or we can put someone in, take some income, and wait for the recovery. And that's just a philosophy. Some owners actually would rather keep a building empty than, if you like, they would be worried that they would prove a lower rent. I don't buy that. I think the rents are the rents. And if you're in a crisis situation, which we are, the rent is different to what I expect it to be in 1 or 2 years' time. I'd rather have someone in paying the rates and paying us something. So that's the sort of the philosophy we've taken. We've taken that there's an acceptance in this kind of crisis. You have to share the burden with retailers. I think almost every landlord's taken that decision. By the way, for those in Europe, the situation in the UK is significantly tougher than Europe because of, and Stephanie can talk more to that, in terms of the measures that the government put in place to sort of prevent landlords from forfeiting leases, and in some cases just was taken as a carte blanche to not pay. It's not as bad on the continent in our experience. So our rent recovery in the UK is quite a bit worse than continental Europe.
Yeah, would you address that, Stephanie? How are you dealing with that in leases? And have you seen the turnover rent become actually a win for a landlord in any situations where, the volume potential and the rent paid could significantly outpace what the base rent would have been, without the turnover rent?
Yeah, sure. So it's interesting, Andrew, that you say in the UK it's so much worse, and then of course for our retailer clients you would say that the UK is one of the best places because of the most lenient and most helpful government intervention that we've actually seen across Europe. So of course it depends on the perspective. And yeah, I mean, turnover is one of the solutions I think that we absolutely have seen, Kevin. Initially, we saw it as perhaps a temporary concession between the landlord and tenant, so something that would cover off, well, obviously closures, there wouldn't be any, but also in that interim period when people were struggling. So it's absolutely seen as a sort of a way of sharing the pain, I suppose, between landlords and tenants. But more and more, we're actually seeing it as actually something that is a permanent feature in a lease. It very often there's a base rent, so perhaps 80-90% is the base rent, and then there's a turnover element on top of that. And I think we're going to see more and more of that. I think probably around 10% of leases are turnover based at the moment, but there's definitely an understanding that this is going to rise to sort of 25, 30% over the coming years. And that's, very interesting from a commercial and a legal perspective as to how that's documented in the lease. And with a changing retail world, with so much change and e-commerce coming into it, and the way that retailers and consumers act in terms of click and collect, and in terms of where they actually make their purchases, this is sort of a really changing and evolving area, which is actually pretty interesting, and something that we're sort of seeing as a bit of a hot topic at the moment in the retail sector.
Okay, thank you, Stephanie. So we're seeing in Europe and the United States where enclosed regional malls seem to have been hit much harder because people were unwilling to be in an enclosed environment, whereas open air centers have really been where people are pivoting to because of the outdoors, and on even on our high streets, depending on where you are. I agree with Andrew and Brandon that I'm not really worried about New York or London. They'll come back. We may not see as many flagship stores per se, but what does the fabric of our high streets and some of our market towns, what do they look like, Andrew, from Redevco coming out of this, in open air centers? And what do you see if you own any enclosed malls? What's the future of those? And, can they be repurposed in a way that's helpful, into housing or some other asset use that is more in line with today's expectations?
Yeah, I'll come on to maybe the repurposing question. What do we see? So I think, our sort of house view has been for the last 5 to 10 years almost that we're going to invest in the biggest and the sort of big growth cities, so the kind of the London, Amsterdams, Paris, Madrids, and so on, and a focus on what I would call more mid-sized kind of livable cities. Again, sorry, I can't give you as examples, but in the UK, it'd be something like a Brighton. In France, it would be something like a Bordeaux. In Spain, it would be something like a Seville or a Valencia. So the mid-sized, but real kind of like I would call sort of lifestyle cities. And I think the big cities will be fine for what we talked about. And I think the livable cities actually might have a bit of a positive impact from the impact of COVID. You see it particularly here in the UK. The housing market kind of out of London's gone absolutely bananas. A lot of people wanting to move out and realizing that you don't have to be commuting 5 days a week or even go to the office at all these days. So I think the movement of people and workforces and changing working patterns will favor smaller, slightly smaller, mid-sized. I'm talking about the really small, but more the mid-sized towns. The market towns, I think I'm not sure. I think they've really got to be attractive places to be. And my comments earlier about we've just built too much retail, I think that you particularly in some of the mid and smaller sized towns, those are the ones that will really suffer. And I think where you've got individual towns that have an over reliance on retail and just too much retail in its city centre, town centre, I think will suffer because I just don't think there's enough occupiers to keep that space filled. And then you've got to have sufficient, and this comes into the repurposing question, then you have to have sufficient values in alternative uses in order to make repurposing an attractive proposition, because repurposing typically is for two reasons. One is you've got no retail use for it, therefore you have to repurpose, and it becomes very much defensive, and someone will have lost a lot of money to rebase the value of the retail asset before you can make it viable for something else. So someone somewhere has lost a lot of money. The other not so often is the sort of the more value creation. Actually, you're repurposing it because you see greater value in something else. We're in the middle of trying to acquire a secondary shopping center in a good town, but secondary shopping center, which we will reposition and then build like 1,000 apartments on the site. It's a good site. And so I think there is and that's a value creation, redevelopment, repurposing of retail. but not all of it will be. And then it really depends, that's really case by case as to where the value is and whether because at some point the value of the retail has to have fallen to a sufficient level to allow a repurposing. And then just quickly on the lifestyle open, so one of the most resilient parts of our portfolio, apart from some of the residential we have, has been we've got a lot of retail parks, often with food anchors, and those have traded extremely well. Or been resilient, extremely resilient, let's say, I should say, on a relative basis. And so that we're very much focused on that sector. And I think there's also quite some crossover there between out of edge of town. These are still within urban areas, but the wide outskirts of town centres, where there's a crossover between logistics and what's happening in the logistics space and click and collect and fulfillment centres. I think there's a whole sort of future view on how retail parks can fulfil both a retail plus a convenience for its local population plus a logistics fulfillment requirement. And we're working on how that all looks, but I think there's quite some retail parks generally are more positive. We don't have so many of the big enclosed shopping centres, as I said earlier. I think some of those, the biggest ones, are probably fine, but some of the mid-sized ones, again, I think will have quite some challenges.
Thank you. So number of issues come up with a retail shopping center when it comes to repurposing. And one of them is anchor stores have clauses where the landlord can't do anything to the property without their permission, no build, no change area. And they'll use that as leverage to control or get bought out or whatever they can, if they can, to extract something from the landlord. So let's say you do have a retail park, but then you've got exclusives and leases in the way. So Stephanie, I'd like your opinion on what you're seeing from tenants cooperating with landlords in that regard, if you're seeing that, and going forward, and Brandon, you can jump in on this as well, are exclusive and co-tenancy clauses going to be the norm, or will they be the exception based on what we've just been through?
Yeah, so perhaps I'll take the last question first around sort of the exclusive and co-tenancy agreements. Well, I think that we probably will continue to see them, because I think that there's certain draw for those anchor tenants that they will bring other retailers into that area. We have perhaps some potential issues around the sort of keep open covenants that you might have in those kind of anchor leases. So that's something was quite interesting at the moment. And that's particularly seen where there's sort of turnover rent, but more and more it's just difficult to enforce those provisions. First of all, pretty much specific performance is not possible. And then the second option is damages. But actually in this kind of climate, when you're seeing so many reasons for why a landlord's sort of reversionary interest might not be doing so well or might not be so strong, it's pretty hard, I think, for landlords to prove that there's sort of a damage because the anchor tenant has closed down or pulled out. So it's going to be quite difficult, I think, for landlords to sort of enforce that. But I think we'll still see them, and there'll still be something that will kind of prop up those moles.
What about the no build, no change area where you have a retail park where a couple of anchors have held on and the asset really doesn't have the same value and it needs to be repurposed? What is the landlord, or what can they do? I mean, maybe they don't have the money to buy out the tenant. Are you seeing workouts that are reasonable, or are we going to see some anchor tenants operating without other retailers around them and they just sort of exist?
Kevin, I think the bigger issue, I'll jump in, Stephanie, the bigger issue is really around zoning. So it's great to be able to say, okay, we want to repurpose this mall to, multifamily. We want to, we're going to take a department store and create multifamily residence, but local ordinances prohibit you from doing that. Mm-hmm. And in some cases, it could take you years to get that rezoned. But I think what you're seeing today is that landlords and the major anchors, if you will, have become much more reasonable in the understanding that they both want to survive and they both want a shopping environment that is profitable for both sides. So it's the repurposing really is around taking these larger vacancies and creating, pre-COVID, obviously, was this whole notion of entertainment, creating this sense, this greater sense of community that you could provide. Well, obviously, if nobody can go into a mall, so it halted that. But I think you're going to, and those options didn't require a rezone. So certainly a large department store wants to see the landlord bringing the mall, the shopping environment with a lot of people in it. And you have to really think about the strategy. What do you want to put into this property to create that type of environment? In which case you will, both landlord and the anchor will be amenable to those. So I think those discussions have become much easier than they might have been, say, 10 years ago. But the other thing too, you want to think about when you talk about enclosed malls in particular, is that the hardest hit asset class was probably moderate to popular priced apparel, which most malls, that was the majority of their occupancy. So they suffered significantly. But the other point I want to make too is that through COVID, many people realized, and now you think about whether it's a West Elm, a Pottery Barn, a Restoration Hardware, these let's call them furniture stores, for lack of a better description, in malls. Think about the logistics. If I wanted to, I'm sitting in my flat in last July and I want to buy a couch, let's say. Okay, I order it online. Well, to go pick it up in the mall is quite cumbersome. So from a logistics perspective, what you're seeing is these users, these operators moving out of the mall simply because it's easier, what Andrew V had mentioned earlier about convenience. It's much easier for me to go directly to an open air center to pick up an item, a larger item, any item, particularly a larger item. You take away that aspect of it too. So you have to keep those things in mind, as well as how are retailers providing a more convenient operating environment for the consumer.
To your point, Brandon, my office is next to one of the largest regional malls in New England, and it has an Apple store in it. And there's one 12 miles away at an open air center owned by WS. I go to the Apple store that's 12 miles away. It's just easier to pull up and walk in. So two things, and I want to ask Andrew a question after this. Let's say I'm a resident, I'm a person who's looking to buy a condo that may be attached to a shopping center. I may be leery to think that the shopping center is going to be around in 10 years. I mean, do I want to have an asset or a hotel or an apartment building, if I'm an apartment developer, let's say, that's attached to a regional mall, and I'm questioning its longevity? Maybe with, I know you're near King of Prussia. King of Prussia is a very strong asset, but I think there's some issue there with attaching to maybe an asset class that could be past its best days if it's let's say a B mall. What do you think, Brandon? Any thoughts on that?
Well, I think the first thing you have to do is look as a resident, you're building an apartment complex or flats, if you will. What is the average stay of someone? How long do you actually live in that apartment? So the notion that you are concerned that in 10 years the mall might not be there, I think as a apartment owner, I'm concerned that you might not be there for 10 years. So keep that in mind. But as it relates to, we'll talk about King of Prussia for a second. The mall itself obviously does quite well. It's being the third largest mall in the country. It has survived. That we'll do a little repurposing with some of the two vacant department stores. But just next to that is King of Prussia Town Center, which is the whole notion of live, work, play, where you have an open air environment, grocery anchored, health and a fitness center, and you've got a hospital adjoining it, as well as multifamily residence. So they're creating that environment. It's not always going to be created within the mall, because the complexities behind the property itself, what I mentioned earlier about zoning. So, again, individual preference. It's hard for me to say that, oh yeah, a person would or wouldn't live, as part of this enclosed shopping mall.
Andrew, we discussed last week pre-call where you mentioned that in some cases, a town in the UK has gotten involved in the real estate business. Let's say, is the town government maybe the last or best place or best group to step in and maybe, let's say there's a mall on their high street, which is the center of their town, and there isn't a buyer to come in and repurpose it, towns coming in and doing this, how are they financing it, and have you seen success there?
I can only talk anecdotally, and Andrew V may have better insight here. I understand that local authorities have been stepping into this over the last few years in quite a meaningful way. And obviously they have the ability to access financing, which is not necessarily SPV. It's more like, quasi-government financing at very, very low cost, bearing in mind where interest rates are. There has been a lot of contention around that recently. So whether that is going to be viable going forward, I'm not so sure, but it definitely has been happening. I think they have been seen as a little bit of a buyer of last resort, but I understand that that window may be closing. But Andrew, you may have a better insight on that.
Yeah, no, you're right, Andrew. It has happened. I think it for a period of time, particularly on smaller, more secondary, not quite distressed, but probably heading that way, shopping centres. At one point, they were sort of considered the only buyer in town. So I think the answer to the question, Kevin, is no, they should not be doing it. They're not equipped to do it. They're not experienced to do it. And I think when you're the only buyer in town, you're either a genius or you've got something a little bit wrong. And I think probably it wasn't a genius move, particularly now. I don't think local authorities should be doing this, to be honest. There are other ways that they need to engage with the private sector and with development companies to facilitate, a bit to Brandon's point about,
Planning,
permitting and planning, and they need to be much more flexible, creative, and helpful to the private sector, who are the people best equipped to get on and repurpose these assets. So no, I to be honest, it's public purse, isn't it? I don't think that's what the public purse should be used for.
And interesting enough, in that space in the UK, I was on a call this morning actually with a whole load of people that was it was a team that was put together to really look at the NPLs or non-performing loans and everything around this space. And actually we're seeing more and more money actually flooding in to look at actually buying stuff, which is actually surprising. Like the investment agents, some of the prices people have been paying, I think, to the upside significantly from where probably people really thought, which is very encouraging.
Yeah, I think that, so I'd agree, Andrew. What I've seen is really almost the last 4 weeks or so, there's sort of early signs of the more opportunistic private equity money that's seeing that, okay, we've actually, I always think a crisis is many things, but one thing it is it's a massive stress test of your business or of a sector or whatever. And, retail's still there. And I think more have survived than we thought, although we're not out of the woods yet, and so it's too early to really make a verdict on that. But I think you'll see such a the whole savings rate, and what we've seen is people being locked down and they're desperate to get out. So when things do open up, there's a lot of evidence now that the town centres and the shopping centres just fill up with people very, very quickly, and they've got money to spend. So I think we'll see a bit of a mini boom, and I think that will fuel more interest from certainly more opportunistic money. That's what one, we have different, if you like, sources of funds, but some of those are targeting the more opportunistic end, and that's exactly what we're looking at as well. And I think there is that sense of, okay, retail's been sort of tarred with the same brush. It's all terrible. We only need other stuff. And it's, it's too big a sector to ignore. It's, historically, it's been 30-35% of the kind of investable market in Europe. If you add on offices, which is about the same again, 60-65% historically, offices and shops. And offices are not having, I don't know if you're covering that in the conference, but offices is also having its moment in the light, right? When everyone's wondering what work from home looks like to the office sector. The two biggest sectors historically, they're too big to ignore. So no, you are definitely seeing a renewed interest, I think, but you have to be very selective and you have to know what you're doing. And again, to the original question of local authorities buying, Not sure if it's my, yeah, well, it's our money, right? So no, I don't think they should be doing it.
So we do want to end on a high note, but one thing I do want to touch upon again, and you mentioned it early on, Andrew V, was overbuilding. So to your point, in the United States, if you count high street retail, or Main Street, and regional malls, freestanding retail, we've got about 45 square feet per person in the United States, which is double any other country. I think UK is, maybe half that. And in the United States, where we have a lot of A malls, B malls, C malls, my contention is as some of the B and C malls close, the A malls get stronger. So when the competition starts to fade away, if you will, or some of these maybe open air shopping centers that are on the periphery, not quite as strong, maybe they don't survive, those left standing should be stronger as the per capita number decreases, as we get into the 25s or 30s. Dan Hurwitz in the United States, who was chairman of ICSC last year, he said, we're not overbuilt, we're under demolished. And to a point that is true. So with the repurposing. So with that said, any thoughts on that? Will the centers that are left and the retailers that are left, be able to capitalize on market share by having fewer competitors, either as retailers or as shopping center owners?
Well, we could talk about that for hours, Kevin. It is a function of, so because there has been no new development or very little new retail development, particularly in the United States in the last 6 years, think about all those retailers looking for space. And there are, each year there are tens of thousands of spaces that need to be leased. Where are they getting them from if there's no new development? And if the mindset of the retailer is we only want A or B locations, they can't expand. There simply isn't, there's no supply. It doesn't exist, which then somebody says, well, the US, UK, you're overbuilt. True, but the majority of that is the C and D space. It's really a question of what are you doing with that space? What becomes of that space? So I think the astute will look at that and say, okay, this is a C mall. If we demolish this or turn the mall, as we say, inside out and created an open air type of situation, will that give retailers will give us an opportunity to lease this space to retailers? So I would say this sort of in closing, retail is by no means dead. Retailers are actually, and landlords, have more technology, more data, more analytics to make them much smarter in their decision-making process, make them much more efficient. So gone are the days of just going to a site and having very crude demographic reports. We know what people are doing. We know what customer profiling looks like. We can understand where we need to put a location. And the chances of those stores long-term being much more successful than they might have been had they made those deals 10 years ago. So for me, retailers actually, what this has done the last year has really forced retailers, and they have the technology at their disposal now to become much smarter. But keep in mind, you need to marry that with their supply chain logistics. Simply because if you can't get goods to the consumer, what's the point? What's the point of opening a brick and mortar store? That technology has become much better. And COVID has forced retailers to really rethink that supply chain strategy, their e-commerce strategy. And they have. They've done quite well with it. So for me, it's very encouraging. I think we'll come out of this quite well, particularly the next 2 years will be very aggressive in terms of deal making out there. And I hope, Andrew V, it helps all of your property as well.
Andrew V, do you want to comment on that, please?
Yeah, no, so look, first of all, hugely encouraging comments. So because the one thing that I constantly get asked by clients is, look, we see this whole string of list of retailers that have gone bust, where are the new ones? And to be honest, I've started to feel a lot more positive about it in the last few months, actually. Whereas maybe a year ago, I was a bit more worried about where are all the new retailers. But I think so. So look, that's really encouraging, and you know, I also believe that the next couple of years look set fair for us as a sector. To come back to the issue of, you know, if sort of a lot of the C and the D malls get demolished or well, yeah, demolished, let's say, does it? I think it will, because I think there'll be a re-rating of the sector by then, because I think what we said earlier is that investors are starting to realize it's not all bad at all. You just need to know what you're looking for. I guess the thing I still worry the most about is where will sustainable rent levels land? There was a really good quote by a chief executive of a retail group here in the UK, and he said, probably a couple of years ago actually, he said, we don't have too much space, we have too much rent. And I thought that summed it up actually, that, okay, so they want all the stores that they've still got, they just don't want to pay as much rent for it. So probably the thing that I think is the hardest question of all today for us to answer, but of course we have a go at it, but it is, where will sustainable rent levels land across our portfolio? That I think is the kind of the most difficult, but in some ways the most important question. And I think the big, you know, the Oxford Street I mentioned earlier about being, you know, when I first started my career in the 90s in London, I was told Oxford Street, it's hugely cyclical, goes up, goes down, along with the economy. It kind of hasn't really done that for, I don't know, 10, 15, 20 years. It's been quite stable, and it's gone up and up and up. And actually now it's having a cyclical downturn. So it will recover. But where rent levels end up relative to where they were post-COVID, I don't know. I think it might take a little while for that recovery to come through in some of those top locations, because the rents, I think, just got a bit too high.
Well, the turnover rent, Stephanie, may be the balancer where the site and how the retailer does matches up with, let's say, the building value matches up with how the retailer's doing, versus just sort of charging an exorbitant rent that has no relation to their sales. What are your thoughts on that?
Yeah, absolutely. As I said earlier, it sort of shares the pain. And so I think that way it's both landlords and tenants are incentivized to sort of, try and kind of make that fair. So I think that definitely is the future. We're also seeing some potentially other ways of sort of other alternatives to turnover rent, which perhaps come out of improvements in prop tech and better data sharing. So I think in Germany, for example, there's a sort of rent based on opportunity. So it's looking at the mall owner is basically responsible for drawing in footfall, and the tenant will pay rent based on that footfall, which is quite interesting, because then it's up to the tenant to make the most of that footfall and, you know, take their profits out of that. So I think we're going to see those sort of developments to try and level the playing field a little bit, I guess, between landlords and tenants, and that will certainly then impact and help with those over rented properties that we've been talking about. Well, and maybe it's not just sharing the pain, it's also sharing the gain. So if, you know, if to your point, if a mall owner or lifestyle center owner or whatever is running a good property and the retailer is able to get the footfall in their door, it is a win-win. I mean, that is part of the whole point in being in a shopping center, you know, or being the owner, to be an active manager. It makes it quite tricky though for the retailer, you know, to sort of lasso the customer to come in their door and sell to them. So they better have their best foot forward when they're doing that. So we only have a few minutes left. Closing thoughts from each person would be great. Brandon, why don't you start us with that, if you don't mind.
Yeah, I thought I just gave my closing summary on how great retail was going to be, okay. But I'll just reinforce that vision that the next couple years, just again similar to 2008, 2009, for a variety of reasons, you'll see much more activity with retailers, particularly in the brick and mortar sector.
Terrific, thanks. You're right, you did. But anyway, Andrew, Vaughn.
I think the oldest shopping center in the world is probably the Grand Bazaar in Istanbul, which I think was started in 1450 something or other. You know, the last few years have been a difficult period for the sector, but it's not going anywhere, and it just needs to reinvent itself. And I think it'll come out a whole lot better than it was in the last few years, to be honest.
Terrific. Andrew M.
I would just say there's a lot of money in debt, a lot of money pouring into debt. They've got to find places that they can lend it, and ultimately, this is a sector where they can get some yield. I think they will be much more granular. To Andrew's point about operating assets, we've seen that a lot. People want a lot more information if they're going to lend into the sector. But slowly and surely, I think that non-bank money will become a very important part of the sector.
Terrific. Stephanie, do you think we're going to see a new level of cooperation between landlords and tenants moving forward? Is it a new bipartisanship?
Yes, I think we have to really. The COVID period has sort of, I suppose, swung both ways. As Andrew said, for landlords, there's certainly been a lot of incentives to tenants that have really not helped landlords. But and actually, I'll just touch on it very briefly as a recent case law that we've had in the UK, which I think was sort of a sigh of relief for landlords, where Westfield brought a claim against the fragrance shop, and then there's some subsequent cases with Mecca Bingo and Cineworld, essentially trying to bring in the COVID defence when they hadn't paid their rent. And the courts very much said, well, no, we're going to stick to essentially the contractual basis of the lease. The government's code of practice that we have in the UK is non-binding, and they actually on purpose left out that one remedy for a landlord is to make a debt claim against a tenant. So I think because of these swings between concessions that help tenants, but then courts that are protecting landlords, there's going to have to be a rebalancing, and hopefully that will be sort of successful for the retail sector overall and for consumers.
Terrific. Well, thank you. I think it's been a terrific panel. You've all informed our audience quite well on what's happening in the retail real estate world. Retail brick and mortar is not dead. It's changing, and it sounds like for the good. And it is not a sector that is going away. It's a big part of many economies. Retail shopping centers pay lots of property tax, and retailers pay lots of sales tax. So very important economic engines in most markets in the world. So I thank you, and I wish you all.
Thank you.
Thanks very much for your participation, and that'll be it. Thanks a lot.
All right.
Thanks,
Thanks all.
Bye.
Thanks everyone.